shift that we're all living in terms of what investors are actually looking at as well. It's very rarely just about the financial returns anymore, and in fact, impact is such a big part of the story. But having said that, there's still these kind of inherent challenges that come along with cap raising in this space. So I wanted to reflect on what is similar, or what you might expect from fundraising in general, no matter what kind of business you are, and then maybe what some of that nuance is around the specific climate tech or climate entrepreneurship category. And as Charlotte said, I'm really keen to have this as much of a conversation as a presentation. You know, I have a particular perspective that I can share, but I think we'll learn a lot more if we can have that discussion with each other, if I can hear some of the challenges that you might have already been facing through the process of cap raising, so we can leave a bit of time at the end for that kind of discussion as well. So with that, I will share my screen and let's see if I can auto-magically get it. No. That is not what I wanted to do. See, Charlotte, didn't work.
I was going to be so impressed if you could.
It was going to be so wonderful, but no, it's not the screen that it needed to be. Let's just try again.
And if everyone could put their company and their display name as well for Lauren's benefit as well as myself, and I'll hand back over to you, Lauren.
One day we'll figure out how people actually do that. Anyway, so with this screen share mode, I can't necessarily keep an eye on the chat. So I do encourage you to just give a shout out if you do want to pause me and ask a question about the specific part that I'm talking about, but then we can continue to kind of have questions at the end as well. So obviously, to kick things off, you know, it's not really a news flash to say humanity is at code red. And the reality is that while this has created a really, you know, critical turning point in how we think about technological development, where we should be directing resources, what needs attention, the reality is that it has also created this, you know, better opportunity than ever to be a climate entrepreneur. Unfortunately, it's one of those things that has taken, you know, a decade too long to be taken seriously and brought to the main stage attention, or for, you know, the shiny new objects in the tech ecosystem to not distract from where we really need to be innovating and spending money. So, you know, these unique factors, we have the fact is that we have the drivers really clear, that the technology has now actually advanced to a point where we can do more, and we can fulfill the potential of climate entrepreneurship more so than we could even 5 to 10 years ago. You know, things like mobile, social, location-based technologies created an initial wave, but now with the increasing sophistication around some of the deeper research and development, and even things like blockchain technology and the opportunities that open up for really meaningful impact in this space, you know, that's certainly reaching a tipping point of sorts. And of course, as I said, you know, the attention is on this space, and we really need to see what kind of innovation can actually drive the change that we need to see in the world. And finally, of course, that the money is actually available to be funding these kinds of businesses, which hasn't always been the case. And to that end, obviously, if anyone had seen the recent PwC climate report, you know, in the last financial year, there was 87.5 billion American dollars raised by climate tech startups across the world, which represents a 210% increase on the previous 12 months. So the time is certainly now, and the liquidity in the market for funding these kinds of businesses is really high. But of course, on the other side, the scope of the challenge that we're trying to overcome is this, you know, 12.9% decarbonisation rate to enable us to get anywhere close to that global warming percentage staying around 1.5 degrees. That should be. So these twin, you know, opportunities and challenges actually have created the fertile ground for climate technology to really take off over the last few years. But I guess the challenge that we're seeing here is that, you know, of all of this funding going to climate tech startups, in fact, only 25% of the available funding over the last, you know, almost 10 years has actually, only 25% has gone to the companies that have been most responsible or could be most responsible for those future emissions reductions. So we're seeing a large number of bets being placed and not necessarily the money finding the companies or the founders or the technologies that are going to have the most significant impact on this future potential emissions reduction. So there's still this asymmetry in climate tech investing. Partly that is about the nascence of the market, the lack of maturity on understanding what makes a really valuable and impactful climate business and how we can direct the right sources of funding. But of course, even just the literacy on the entrepreneurship side, how we need to go through a couple of cycles to make sure that the founders, the teams themselves have that operational experience to take that investment and kind of stretch it to where it needs to go to enable that impact to actually be realized over time. So from that perspective, this is the global stage, but certainly it's even more so true in Australia. We need to build these bridges between, what high impact, high potential companies can exist in the climate technology space and make sure that they can actually find the appropriate capital based on their stage, based on their trajectory, based on the specific discipline or vertical that they sit within underneath this climate tech umbrella. So I would say this is the pivotal challenge that we're really trying to overcome in the climate tech investment side of things at the moment. So when I was thinking about what to share with you all today, thinking about what is unique about climate investing, it felt really pertinent to actually illuminate at the same time what is the same. So regardless of the industry vertical that you might be in, there are some facts about capital raising and specifically venture capital raising that are true no matter which industry vertical or which kind of specific technology area you are working in. And these do bear keeping in mind as you approach the fundraising journey, because it's very much about going in eyes wide open and knowing what to expect as much as it is about knowing what you want to get out of it at the other end. So the first of these kind of core pillars of basic literacy about the cap raising journey is that we are really talking about a 10-year commitment here between the funder and the founder. So the entrepreneur is really looking to find not just the capital that they need at that particular point in time to kind of plug the hole in the budget and give them that extension of runway that they need to fulfill the potential of the business. They're actually genuinely looking for a partner, whether it's a thought partner or whether it's just a supporter who can continue to provide that critical support when times are difficult, when decisions need to be made about the trajectory of the business. So this isn't just a single point in time transaction. This is a long range relationship. And it's a commitment that you're making to each other to see that through. So as I said, this is true regardless of which particular vertical or sector in the technology space you're in, but it is something that can be underappreciated at the start of the journey when you're simply looking for the dollars and for the check, rather than that person who is going to be your champion through that period in time and open up other doors and opportunities that you need to be successful on your journey. The second, was there a question there? No, all good. The second critical thing to keep in mind, of course, is the notion of the VC power law, which anyone who has already gone through this investing process or raised money before will understand. The reality is that when venture capitalists are making these investments, we see the so-called unicorns that are celebrated in market. We'll see the venture capitalists talking about which ones of their companies are breakout successes in the portfolio. But the reality is success for a venture capitalist actually looks like only 1 to 2 of any 10 investments that they're making being those success stories. So there's a knowingness through the investment process that of those 10 deals, there will be 2 that need to have these outsized returns. There's 5 or 6 in the middle that will have what might be average to successful returns. They may still well be good businesses, but they aren't necessarily providing the returns on the dollar that those unicorns might. And then there's an expectation that the bottom kind of third of those businesses in the portfolio will actually fail completely and may not even return the capital. So that's all well and good for the venture capitalists to have that understanding of their own portfolio. But the challenge comes when they're making the investment decisions. They're not trying to invest on the basis that there will be a middle chunk that will kind of middle out. They're actually trying to invest on the basis that every single one of these businesses has the chance to be one of those top 1 to 2 businesses, so that they can't, they sort of need to enter this relationship with full conviction that you could be a what you call 10x return businesses. So every dollar that they put in, they're going to get $10 out ultimately for their investors. And this makes the bar, even higher, especially for the case, within the climate space, where the predictability of success has so many other factors. And I think that's where we do see some reticence or people holding back from the climate investing side of things because of that lack of predictability, where you might be able to have more reliable predictors of success for a SaaS business, for example. So that power law is really critical to the business model of a venture capitalist at the end of the day. The third key factor, and this is something that becomes a lot more clear the longer you're in the industry, the reality is that an average investor at a firm like Blackbird or Airtree will see upwards of 1,000 deals per year. Even at Startmate, we have 500 applications every 6 months from which we choose our cohorts. For every investor, they're really only making 1 to 2 deals per year, because they have to be these extremely high conviction, power law returning investments. So you can imagine within the kind of scale that we're talking about here, with 1,000 deals coming through the desk, to only be making 1 to 2 of these investments, there will be a huge number of still incredibly important, valuable, probably successful businesses that just don't make the cut for a whole bunch of other factors and reasons, which we can dive into as well. But the reality is, from an investment standpoint, these numbers aren't necessarily on the side of the entrepreneur. You really have to know that you're doing the breakout thing, the breakout technology, the breakout, the game-changing technology that's going to mean a different way of life for people, so that the investor can actually guarantee that conviction will be well placed. And the final thing here on the risk versus reward side of things kind of speaks to what I was saying before, where for the most part, an investor is looking for this 10x return on their money so that they can then return the capital to their LPs. So they want these outsized successes, but at the same time, they have to balance this notion of taking huge risks. So they're always taking calculated risks that have a high probability of success. Even if they're ultimately aiming for this 10x return, they need to know that a company isn't guaranteed to fail completely. Sorry, somebody's mic's unmuted. I just thought I'd let you know.
It's such a weird world.
Somebody, Jonathan, I don't know if you can hear me, but your mic is on. So really, when you're looking at a business in the climate space, that idea that it could succeed above all else, or at any cost, is a lot harder to have conviction in, given the amount of the constant changes in the environment, the external factors that will have a large role to play in the success of that business, as opposed to some of these more predictable B2B or B2C market businesses. So this balance of healthy skepticism is really necessary, but it can be kind of a critical flaw for climate tech founders, because that skepticism can essentially mean that the disbelief in the potential of the business is not given the license to actually take that investment at the end of the day. So this healthy skepticism mixed with optimism is a very specific sized box that only a certain number of entrepreneurs and founders will actually fit through. So just to pause there, are there any questions from anyone in the room about the idea of the capital raising process in general, and some of these dynamics of the VC power law, or the sheer number of deals that VCs are seeing? Just to pause there.
Lauren, Mick,
yes.
Not sure
hey,
if you.
Mick.
Hey, how you going?
Good.
Thanks for doing this. Already really useful. Just wondering, you might be covering it later, but in terms of the time it takes to build a relationship to get these to get investment, and the fact that normally starts quite early.
Yes.
Just on the basis of that, 1 in 1,000 deals, especially. If you read in the paper, you think, oh well, they just funded that company. Did they call them last week and get a term sheet, or I think just it's another part of all cap raising, which would be interesting to get you a sense of. Lauren? Oh. I've frozen, or is everyone else frozen?
There is a huge storm happening on the Sunshine Coast, so maybe.
You want it.
Oh, she's back.
Sorry. Oh, did I drop out?
Oh, you probably had perfect articulation of the answer, but
it was brilliant. No, I'll try again. Sorry, the connection's a bit funny because of the weather. So yeah, as Mick was saying, you know, the reality is you don't want to be raising money the week before you need it. These relationships are built over a period of 6 to 12 months, as you would expect any kind of 10-year commitment to take to actually build that level of comfortability, to build the buy-in for the business, but not just the business, for you as a founder, as an entrepreneur. So really what you want to be doing as early as possible, as early as there is this sign of traction, or that you have a base point to build a relationship from, that you can keep somebody in the loop of your progress over a 3 to 6 month period of time at the minimum. I think that's really a critical part of the success of the fundraising journey. And I do touch on it a little bit later, but that's certainly a really key principle to draw out now. Thanks for raising that, Nick.
Lauren, how does one start that relationship? I love how you compare it to it's longer than most marriages. But not say you're a year ahead of when you're going to start cap raising. What's the impetus to reach out to an investor? Like, what are some good ways to start points?
Yeah, it's a great question, and it probably starts to relate more to the climate specific side of things here, because what you're really looking for is that much more nuanced alignment between what you're building and what an investor is interested in. And I think so often, we're looking at the pool of investors, the whole industry of VC, and seeing it as kind of one homogenous mass. And you just need to start kind of sending emails, taking calls, and meeting people. But actually you want to find this unique connection point that's relevant to your business and to an investor who may become one of these champions. You certainly have to, put in the time and get up the numbers to find these people. They're not going to be automatically visible, but with something like climate specifically, of course, you've got a whole range of ways to connect with like-minded people. That is probably the most critical entry point to finding these champions. You will have investors in this space writing a lot about the topics, reading a lot about the topics. How you can get in the way of their own research would be one particular way. So to make sure that you're also publishing and kind of sharing the story of what you're doing, because these investors are constantly searching, it's more likely that they will be scouting actively for the businesses they're investing in than likely that the right person will just walk through the door. So I think we talk a lot about it at Startmate. It's this increasing surface area of luck. I think everything that you can do to be more visible, be more vocal, clearly articulate the success that you're having, or the ambition that you have. These are ways to make sure that you'll be noticed, because you've got the investment community actively searching for you on the other end. We will dive into it a little bit more later, so I'll keep moving forward with this particular topic now. So taking those kind of facts around the traditional venture capital landscape and what it means for anybody to raise money, I wanted to overlay where I think there are these kind of opportunities and constraints. They're kind of twin opportunities and constraints, or flip sides of the same coin, depending on which way you look at it, of investing in climate tech specifically. And the first one that I wanted to call out is the fact that many climate specific investors have this deep domain expertise, which is super valuable, because what you want is somebody to understand the complexity of what you're building, rather than having this kind of very top line understanding of the industry you sit in, without realizing the importance of the technical innovation or the capability that you bring. At the same time, this does actually create a really high bar that not all other entrepreneurs have to clear when they're building their businesses. To have somebody with such specific knowledge, they're going to be dissecting your business to a degree that not all startup founders need to endure. I think maybe with key verticals where there has been a lot of tried and tested practices. So, you know, SaaS businesses, for example, which I mentioned earlier, have very clear benchmarks that, you know, an experienced SaaS investor will be looking for. So there is some commonality, but I think when you're talking about deep domain expertise and deep technical knowledge, there's a whole bunch of other things you need to be aware of in how you're communicating about what you're doing, and having all of your details kind of really shored up to make sure that your story is as comprehensive and cohesive as possible, because they will know what they're looking for. The second key thing that I think is different here is the deployment of capital and the length of time that is likely needed before that ultimate return, or maybe not ultimate return, but even the first indicators of success and progress are actually visible. So you want to find these investors who aren't looking for you to turn this business around in 3 to 5 years with an exit, or that you will have clear signs of product market fit in, you know, just a few months, and you'll be generating revenue within a year. I suspect that most businesses in this space need the time and the patient capital to actually invest in the research, truly understand both the problem that they're solving and the solution at the same time. So, you know, aligning investment around those kind of principles is really key as well. You will find that embedded in most impact investors, people who specifically are calling out the fact that they're looking for impact-based businesses to invest in. It can get a little more grey when you're talking to the general investor community who have different thresholds and tolerances for those things. And it's just about being kind of aware of which milestones you think you'll be able to demonstrate progress against to enable you to, I guess, get more investment down the line, if that's what you're heading towards. Rather than them going, well, it's taken you 3 years to get to this point. That wasn't fast enough, so we think this isn't a going concern and we can't continue to support. So those conversations and getting a clear alignment on values upfront is really key there. The third point that I call out here is kind of related to that one, in the sense that it's much more of a default for investors to invest or to be looking for impact in their portfolio today. But when it comes to climate tech, it feels like there's it's a binary equation of, you know, no impact and all the impact in the world that's going to save us all, you know, and it's really trying to understand what that, you know, what that milestone based success can look like, where it's leading you to the ultimate potential of what your business can do, but that there are some clear and specific wins from a market-based perspective. You know, what are the commercial successes that can be clear as signposts along the journey toward this outsized climate impact? I think, you know, impact investors, again, as I mentioned, will have a greater tolerance for the impact measurements over the commercial measurements, but I think even still, there needs to be this sense of the building blocks that come from you know, investing in this technology and waiting for this kind of endpoint. There has to be some kind of midpoint that shows people you're on the right trajectory and that you can demonstrate some level of impact earlier rather than later. This is particularly difficult, obviously, for, you know, deeply research-based technologies where, you know, it may take 2 years to even get a prototype that you can test, but it's about mapping out and understanding what those milestones might be, so everybody's aware along the way. And then the fourth, which I think is the most challenging problem to face, is what I'm calling here the Goldilocks problem. I'm sure I've just taken that framing from some other business school example, but I do think that the challenge with climate tech and with impact investing in Australia in particular, but also globally, is this balance between, you know, it has to be commercial in some sense, it has to be practically implemented, you know, from those milestones, as I mentioned. The impact has to be enormous, the time frame has to be not too long, and then of course the investors themselves will have a really specific interest in decarbonization using seaweed, you know, and it's like getting closer and closer and closer to a field of maybe 2 to 3 people who might be the right investors for you out of a pool of thousands. So that's a real challenge. because you have to navigate, filtering out for your own benefit, so you're not wasting time, talking to the wrong people. But also, you don't want to, as I mentioned before, like increasing the surface area of luck. You don't want to miss what could be a really interesting conversation that might lead to another, fruitful opportunity. So, understanding all of the levers that an investor is looking through, and being really cognizant of where you fit and where you map on this process. So you know that you're not going to have a commercially viable business for X number of years, but that the impact is going to be bigger than anybody could even imagine. And you've got this team who have proven expertise on the execution side. So that's what warrants the investment. It's trying to figure out what that combination of more reliable factors are that enable an investor to take a bigger leap, given that the pathway isn't as cut and dried as it might be in other different areas. So there is this Goldilocks challenge, but as we touched on earlier, more and more investors are turning their mind to climate technology, impact investing in generally. And I think the opportunity here is actually one of education, which is what we were sort of touching on before, how vocal and how clear you can be about not just the business that you're building, but the opportunity that you're solving for, or the problem space that you're solving for. We need more published and communicated and spread more virally around the work that's being done in this space, and that tends to catalyze the support in the right areas. Whereas right now everyone's kind of flying a little bit blind and trying to become experts on something that they know nothing about in a very short space of time to make what is typically $5 million decision. So to the extent that you can influence that Goldilocks problem, you will be in a much stronger position. Mick, yes.
I'm not sure if you're going to cover it again, but
Yep.
these four things made me think about strategic investors, which is
Yes.
quite a big deal in climate tech.
Yes.
And has both opportunities and constraints. Are you going to touch on that, or
I will touch a little bit on the funding landscape, and I'll make a special point to talk a bit more to that. Yeah, thank you for pointing that out. So this is actually the very next thing that I will talk about, which is great. So with all of this in mind, you've got your general, it's hard to fundraise, you've got but I'm also a climate tech entrepreneur, and I need a very specific type of funding.
Yeah,
what
does
it mean? Somebody's on it. I can't see who that is. So then like, what is it that you can actually influence or impact to be able to, I guess, control the narrative ever so slightly, or help move the tide in the right direction towards your startup? So I see that there are three key areas. I've put them in this order. It's almost the reverse order in terms of importance, but I think in terms of like practically speaking, what you can do today, tomorrow, and kind of continue to work on from here, this is the way I would put it. So the first of these is the funding pathways, which we were just about to touch on. So I mentioned the VC power law earlier, and I think there is a general narrative in, not just in Australia, in any kind of startup ecosystem, that venture capital is the most important pathway of funding, or the sign that your business is the most successful it can be. And I think this narrative is really changing, and it's very important that it does, because there are so many pathways to raising the capital that you need, and venture capital suits a particular kind of high growth business, or potentially capital intensive business. So there is definitely a remit for really targeted venture capital in this space, but it's not always right for climate focused businesses, depending on the sweet spot of your kind of customer focus, or even the sub industry that you might be in within this space. So these are all of the funding pathways you might want to consider. I think something like bootstrapping obviously is less helpful in the climate space when we're talking about investment in technology, lots of R&D, all those sorts of things. But in the case that there is a really smart market solution that you think has paying clients sooner rather than later, that you can test with an MVP like all other startups, and I think more and more there will be businesses that fit in this category. Bootstrapping is the most steady and slightly predictable, maybe not always predictable, pathway to growth that allows you to do this on your own terms and lean into the fact that there is there is a market for what you're doing. You've created a solution for a problem that people genuinely have. So more and more it's being held up as a really smart way to go. But it's not for everybody, and it certainly has its constraints for these capital intensive businesses, as I said. Grant funding, in market, I think can be useful to give you that early start on the research and development side of things, or even just the MVP funding. I'm not sure if the New South Wales government still does that MVP grant. After all, there's been so many changes in the landscape, but that catalytic capital that allows you to take the time that you need to figure out what those proof points or traction points are in your model before you then maybe move to that next phase of actually seeking external funding. So yeah, whether it's research and development, MVP type, early business grants, they're all really worthwhile at that kind of startup stage or pre-startup incubation stage. Then moving to angels and accelerators, I think this will become the area of the most activity from a, maybe not from a dollars perspective, but from a volume of activity perspective. More and more high net worth individuals, startup operators who have money to invest, and of course accelerator programs and incubators and all the rest of it are putting the focus squarely on climate technology because they see the need for money to be invested at this stage of the business. And I do think that's probably where there is a gap. Generally speaking, in the funding landscape, we've got large amounts of dollars going to more established climate businesses. We have less of the experimental risk-taking pre-seed or early stage capital going to climate founders who need to kind of test, whether they can achieve minimum viable product and product market fit before they take on some of this extra capital. But that's a really underserved area of the market, and I think something that is worth kind of exploring more for that early stage funding as opposed to going straight down the VC path. There are lots of angel groups emerging, but also you start to see syndicate program or syndicate models emerging, whether that's like the Aussie Angels Syndicate or something like Flying Fox, who pull together groups of investors on your behalf. You don't have to meet all of the angels, but they are pulling together people around particular deals and getting that kind of crowd support. On the flip side of that is equity crowdfunding, which really is the crowd, obviously. But again, depending on your business model, if it's more business to consumer focused, equity crowdfunding can be really valuable because it puts you right in the hands of your target market, your consumers. It can also be relevant for the B2B market. We're starting to see more business to business technology using equity crowdfunding and, again, getting clients on board to make the investment and be an equity owner of those businesses. But it's just worth being aware that it is as time consuming as raising a venture round. So it really needs to be aligned to your strategy of how you're thinking about going to market and really making the most of that attention that can come through the process. The next category, which is probably the most emergent in Australia, but again, one of those really critical ingredients to the funding landscape here is revenue-based financing. So we're starting to see debt providers actually giving people, what a bank might have given as a line of credit, but is near impossible for a startup to get those kinds of loans from the bank. Essentially, making a loan against future revenue and then getting paid back based on the income or the revenue that the business is getting from a percentage basis. So it actually rides the wave of any lumpy revenue that business is getting, and can be quite cost effective. There are obviously costs involved from the interest perspective, but certainly if it's more predictable and you just need that front loaded capital to get you to reach some level of profitability or neutrality, then revenue-based financing can be a really good pathway. Gordon.
Thanks. Thanks so much for your presentation so far. I just wanted to think about revenue-based financing versus venture versus equity capital of any sort, and find a way to model the kind of impact and the cost. Like, it's really hard to think about if you could get both, which would you want? If you do have a revenue stream and you have a growth ambition, and it's kind of like an apples and orange comparison, right? You're trying to say, well, this is going to cost us money and this is going to cost us equity. So which is better, and under what circumstances is each better? Are you aware of any resources to help model that, or advisors who are really good at that?
I genuinely think that the work that Matt Allen is doing at Tractor is probably the most useful for entrepreneurs to really understand the different dynamics of these types of financing. I would say it's most often appropriate for there to be a mix of both. And we are seeing, I think, founders understanding exactly what you just said. Like, there's an opportunity here to, get some financing for this more predictable aspect, but we also need to take a leap from a growth perspective, which is where equity might make more sense, or is cheaper for us to do that. But yeah, Matt Allen at Tractor, and I think the lighter capital team here in Australia is also, really helpful in understanding where revenue-based financing is most appropriate.
Sorry, go.
That's okay. No, that's fine.
I was just to say, sure. I've spoken to both, but obviously they have an interest in telling me that revenue-based financing is the way to go because they want to sell it. So any other suggestions?
How do you get an impartial view? I think the reality is, at the end of the day, you're the best, and this is a horrible answer, but you are the best person to understand what kind of threshold, ownership is usually worth more to people than, paying interest. I think that's certainly the message that the revenue-based financing leaders are talking about. Giving up ownership in your business is clearly more expensive. However, there will be times where, for many other reasons than just the investment itself, it makes the most sense. There's obviously network benefits that come from taking venture capital and being exposed to the resources they have to offer. Yes, maybe some of the revenue-based financing companies will be able to service their portfolio in similar ways over time. But yeah, it's never just a question of dollar for dollar. I think it's much more of an emotional choice, and it's a choice around how you see the trajectory of your business, and whether you want to be on that venture capital ride is probably what I would say.
Yeah, and maybe as you say, it might be timing. I'll let you go on.
No, that's fine. I was going to say, I'll talk about venture capital now, because I think that is the choice point. It's like, are you on the venture capital ride? Are you an attractive prospect for venture capital? Do you have expectations of 10x returns in a 5 to 10 year time frame? But also acknowledging that venture capital is essentially a treadmill that will require you to continue to fundraise until some point in the future, where you've got whatever liquidity event you're aiming for, or kind of whatever success metric that you're working towards. So that's the caveat with venture capital, I think. Whereas you could easily see yourself tapering off any other kind of financing through that process. Now, Mick mentioned before, within this venture capital bucket, there's a number of different players. There's corporate venture capital, which might also be considered your strategic investors. These are usually companies or entities attached to companies that have, a specific mandate that links back to the kind of parent business. Reinventure, which is the venture capital fund that I worked with, was essentially a strategic corporate venture fund of Westpac, and we always had the consideration in mind as to how our portfolio could be strategically valuable to Westpac above and beyond that financial impact as well. So the caveats there are, of course, that there's competing priorities around whose needs are more important in those situations. A venture fund that's just got pure venture capital with LPs that are less visible to the entrepreneur really just wants to see you succeed at your business, and will usually throw a lot of what they can at you to help that happen. A strategic investor may have a really clear pathway for how you can be involved in their business, but it may compromise your own visions as an entrepreneur, or may cut you off from different other sources of funding if it feels like there's competitive tensions there. I would say in the fintech landscape in Australia, there's been a lot of success with the collaboration in multiple banks being on the cap tables of particular startups, but it still doesn't come without its challenges at the same time. And I expect in the broader sustainability and climate area, there will be a huge role for strategic investment to play that may be able to moderate the venture capital expectations of a traditional VC, but certainly won't be the right fit for everybody. And the other one that I mentioned in there is more of your research-based, deep tech, maybe university connected or research institute connected funding, which is really going to obviously support on the R&D side. So a fund like Main Sequence Ventures being a really obvious example of somebody who's doing great stuff for the climate tech space in Australia. So that's a fairly comprehensive lens on funding, but of course there's so much nuance in each of these subgroups. I think it's really the question here is to understand what kind of business are you building and what capital suits your purposes over what period of time for you to do that fundraising in. The second part, which more goes back to Charlotte's point before, or maybe it was Mick as well, this notion of knowing your audience, the funding is one thing, but as I mentioned earlier, it's not just a transactional, like, I need this money for my business is going to be a success, please give me that money. There's so much emotion and nuance and layers that go into building a strong investment relationship. And the reality is that every business is looking for a one of a kind. But in the case of climate tech, your pool of champions to pull from is perhaps slightly smaller or slightly nuanced compared to average startup. So it's going to take a lot of work to get that combination right, which is also why the length of time that you expect to spend fundraising is so key. You don't want to be surprised to feel like you need to get money within 4 weeks and realize that it's an absolute maze that you need to navigate, and that building those relationships is going to take a lot more time than you think. So the devil is in the detail here. So climate is a massive category. I think that's the first thing I would say. People can talk about being climate tech investors, but what you really want to understand is, what that means to them and what kind of alignment they might find with your particular business, because you will start to hear a lot of nuance within that broader category. And as you yourselves know, some of you may not consider yourselves climate entrepreneurs. You might very specifically consider yourselves wind entrepreneurs or decarbonization experts. So being nuanced and specific for yourself can actually be really beneficial, as much as it helps to tell this larger story around climate technology. So the second aspect of that is, of course, within this world of venture capital and other debt funding providers, there will be a size check that you are looking for that only a few investors will typically write. There will be a stage of investment where they're more suited. So as I said before, I think there's probably more growth capital available for climate tech businesses in some ways than there is really early high risk appetite seed stage capital. So knowing who you're talking to and where their skill sets are best placed, a lot of investors really have a preference as to where they play. Pre-seed, seed stage, these are the really early product market fit rounds, as opposed to Series A, where you're kind of getting into that expansion and growth phase. So you want to understand their history and their background and how that might suit yours. And then the thesis area, as I mentioned, within that climate category, investors will have a really specific view on how they see the future of climate tech evolving. They have a belief in the kind of future state of the world that they're trying to design for through their investments, and understanding how they view those things can either mean that you can see the direct alignment, or that there's actually an opportunity to educate them on an alternative pathway that they haven't considered. So this is where that relationship building side of things comes into it. It should start as a conversation and ideally continues as one. And then the last point there is that technical expertise question again. In some cases, this is going to be hugely valuable. In other cases, you are the technical expert and you don't need anybody who is, an expert generalist in lots of different areas trying to add value in that place. Most VCs are generalists across a range of different areas. But what you'll need to work on with them is making them have conviction in a space that's unfamiliar to them. They need to learn enough, understand enough, feel competent to talk about what you're doing with enough conviction without having that layer of depth to their understanding. So this is the challenge of you as a kind of to impart what you're doing in a way that they feel really confident to take ownership of. Because when you walk into that pitch meeting or into the partner pitch, they're ultimately advocating for you on your behalf, and they need to feel like almost an extension of your team by that stage. Which leads to the last part, which I think is the pitch. It is the most important thing. It's last because we could spend a whole other hour talking about this particular area, but I think there's enough to mull over here, I think, that that will help you shape some of the conversations that you're going into. Climate tech can be really overwhelming for the average person. Yes, climate tech investors are going to be more immersed in it than usual, but again, they need to feel a level of competence within that overwhelm. They need to understand the scale of the problem and why it matters beyond just we're going to, reduce X amount of carbon in the atmosphere. It's like, what are the layers and the nuance to that problem that gives them confidence that you're doing something differently to the next startup that they might encounter. And then the depth of your solution, again, the expertise that you bring to that solution, the team, the background, and why it's why it's going to make the difference and why it hasn't happened before. All of these parts of your pitch are so critical here because of this kind of information asymmetry and confidence gaps in climate investing and technology in general. So it's still an emotional decision, and I think a lot of businesses in this space are coming from a research, science, very complex and maybe clinical environment, and not always the storytelling masters that you see in the kind of peer-to-peer economy or the on-demand economy. All of those storytelling experts that could sell ice to Eskimos, for want of a better expression. We actually need to borrow some of their storytelling nous and reduce the complex to something simple without understating the impact of what you can have. So if you spent all of your time there, it would probably be well served. At the same time, the nuance here is that traction looks really different in this space than it does to the average startup, and understanding what your traction measurements or your the metric that matters to show your business is heading in the right direction, even if there are going to be large amounts of time between the milestones that we talked about before. This is about signaling your credibility as a team. It's not enough to say, we've got all this technology and in 5 years, we're going to change the world. It may well be true that you need to be able to demonstrate what you're doing tomorrow and the next week and the next week. That gives that sense of momentum, whether that's on the customer side, whether that's on the technology side. But it says as much about you as a founding team and the culture of the founding team as it does about the work that you're actually doing. And certainly, from an accelerator perspective, it's possibly the most important thing that any company can focus on coming through the program. And then finally, the market potential, which, is a funny one in the sense that for a great business, the market is an unknown anyway, because they will actually create the market that they're serving over time. But in the same vein, there needs to be a clear understanding of what that immediate market looks like, and it needs to be attractive enough for that venture scale investment that I was talking about before. Within this space, there are so many worthwhile technologies, solutions, applications, but even if they got to their fullest potential, as we understand it, would still only be, X-sized market. And I think that's the challenging conversation to have in the venture arena. Unless there is this logical kind of extension from one market to the next with the same technology. So I'm sure the depth of obsession with the technology and the problem that you're solving is probably a no-brainer, but sometimes putting that commercial hat on and understanding why it's also a good investment is the last part of the puzzle to be able to bring everybody along that journey with you. So these three dimensions, that's not a complete pitch, but I think they're the things that climate entrepreneurs probably need to work a little harder or think a little different than the average easier to understand business. And just think of this as that storytelling journey to build emotional connection and get people excited for the ambition of the problem that you're solving. Nick?
Sorry for lots of questions.
That's okay.
some people think of pitch and think of the single perfect pitch deck, but you talked about building the relationship and the emotional connection.
Yeah.
Is the pitch about one beautiful 17-minute perfect presentation, or is it more?
No, I think it's funny that we get companies to practice pitches so much. I think there can be validity in refining your pitch so that you use your words as efficiently and effectively as possible, and you can tell that story. But it would be rare that you're walking into a room to run through 17 slides without interruption and rehearsing, using the pitch that you've rehearsed. I think what matters most is finding these points for emotional connection, and it's that quote. I think it's Oscar Wilde. I'm probably going to misquote that. It's like, I would have written you a shorter letter, but I had no time. And that idea I probably watched that quote, but it's like the idea to reduce something to its simplest essence actually takes a lot of time, energy, and effort. And that's the process of building a pitch is probably why that's so useful, because you get to refine and refine and refine your message into its most raw elements. And then you can freestyle from there, because you've actually embodied what it is your business does and the way that talking about it really resonates with people. So that's how I like to think about the kind of 10 to 15 pitch slide, leaving the irrelevant stuff on the floor and getting into its essence. Audrey.
Yeah, I just had a quick question around like in the first part you talked about how there's this information asymmetry with climate tech investing. Do you know of any like resources, like educational resources that we can kind of lean on to find out like how we can find out like what it does make a successful climate tech company? Or do you have an example of any VCs who have done it well? Like how do we actually solve that issue or that information asymmetry?
It's a great question. And in some ways, I think, the work that Climate Salad's doing to even draw attention to this subset or this part of our ecosystem is really important. There are a number of investors who've been able to make their name on the climate side of things. So, lower carbon capital, or even the work that Grok is doing to see how they've been able to create that develop their thesis and understand what good looks like in that space. But in an Australian context, I think there is so much more to be done. And even in the global context, I think we're still relying on the PwC reports and those really kind of larger ecosystem analysis pieces to fill in the blanks, rather than having this much more industry specific content. So I think that is part of the opportunity. It's a lot of work to put on the entrepreneur's plate, but I think we've seen it before with other trends and movements where, galvanizing the ecosystem around ideas like the sharing economy is probably the example that I have, kind of starts to put the wheels in motion, becomes a self-fulfilling prophecy in a way as well.
Yeah, cool. Thank you.
You're welcome. So look, that was the last slide that I had that really had any real substance. This is more just to kind of honestly say, purpose will be that game-changing factor of business of this century that we're living in. And the reality is that you're all leading by example. It's going to be a challenging journey because you really are the ones blazing that trail. There's no pathways that have been kind of forged for you. But I think community will actually be a really key part of that. And, kind of to Audrey's point, how do we actually start to tell these stories collectively? How do we draw more attention to what matters? How do we understand what success looks like and understand what failure looks like? I think, Mick will be able to share lots more war stories around the early days of the startup ecosystem in general. The way that became successful was by sharing the hard stuff as much as celebrating the good stuff. And we're certainly at that kind of inflection point if we want to make climate technology one of the key sectors of our ecosystem over the next 5 to 10 years. But we need you to kind of keep blazing that trail. So, congratulations on all the work you're doing and look forward to following all your progress as well. And if there's any more questions, I would be happy to take them, but I realize we are also at time. David. Oh, you're on mute, sorry. Oh, still.
Just muted myself and then
there you go, a double mute.
Awesome. It's that time of day. Thank you
Yes.
so much for that talk.
You're welcome.
I guess my question is, there's sort of a parallel in finance where, you know, you want that unicorn, that 1 in 100, you know, 1 in 10 that's going to do really well. And in the kind of state of the art of tackling climate change, there's sort of a parallel in that there's people working towards the very incremental improvements.
Yeah.
If my business is wildly successful, I'll make this thing 1% more efficient. And it'll rely on that scale up. But I'm really confident it'll work. Or there's the ones where, look, it's a moonshot. It probably won't work, but if it does, everyone will be talking about it forever, and it'll change the world.
Yeah.
It seems to me like the kind of investors who would tick one or the other would be completely different people.
Yes.
How do you screen for that? How do you have
yes
that,
it's a really great polarization. I think there are these two camps. I would say as venture funds grow and as this thematic becomes more and more interesting, you might start to see that change. Even in the kind of the ones looking for the moonshots will start to appreciate the smaller scale improvements as well, especially if it can be one of those improvements that catalyzes a whole bunch of other things to be done off the back of it. I think it's really understanding the whole opportunity of the innovation, not just the specific outcome of the innovation as well. The idea at the end of the day is that venture capitalists are looking for that, you know, outsized outcome on a whole range of different factors. But if something is a building block, a necessary building block to get there, there's still a huge story to be told. I think the question for that is the time that it might take to do that, and the race that we're in to see it happen sooner rather than later. I think good people on both sides will want to hear those stories. It's just a matter of what makes sense from an investment perspective. So I'm not sure you need to screen for it, but perhaps just be conscious of which conversations you're in, because I suspect you could benefit from hearing or getting both of those perspectives. And certainly there's nothing like a conversation with a VC to stretch the ambition even further, or to better understand your business and its full potential in a way that you hadn't even thought possible. So potentially just a matter of that self-awareness of what's going to be more useful for you at that particular point in time.
Yeah, great. I mean, I'm kind of in the energy space, and it seems to be one of those things where everyone just gets super passionate about it out of nowhere. And it can kind of work in your favor or not, depending on what you're doing.
Yeah, that's it. Depends on the flavor of the month too, I'm sure.
Yes.
Awesome. Charlotte, I don't know if you need to wrap things up, or if we have time for any more.
I think the school is closing, so I might have to go.
Okay.
Sorry about that. Even though the sun's now apparently shining. Thank you so much. I mean, I can always make Nick, the co-host, host. It's so great.
I'm happy to also answer any questions later if anyone wants to reach out, of course.
No? Well, please
do. Question, sorry, Charlotte, if you need to sort of say your goodbyes. Mine's just a technical question. But back to the comments you made at the start, about 25% of that 87 million, only 25% of it going to the companies with the most potential. So where does that come from? Is that from a...
So it was actually 25% of the investment over actually a larger period of time, over the last decade or so. This is in the PwC climate report. Essentially, they've tracked or understood, you know, the innovations that have led to the most, or could lead to the most impactful reduction in emissions, and actually the investment hasn't been funneled necessarily accordingly. There's still this kind of wide distribution. I guess people are still taking a range of different bets, but it's more to say that we still don't understand or aren't drawing attention and doubling down our resourcing support on those companies that have this chance to make a step change. So there's just a misalignment there, and may well be heading in the right direction, but cumulatively over that period of time, since I think 2013 was the time frame. So I can share that report, because it's got a lot of interesting analysis, I guess, of the subsections within the broader climate space as well.
Yeah, I'd love to see that report.
Yeah, cool. I can I'll share that with Charlotte, and she can share it with all of you.
Thank you so much. I'm sure you'll all join me in thanking Lauren and lending her planet-sized brain and wealth of knowledge and experience within the startup ecosystem. It's so great to have such a wonderful hero and role model in you, Lauren, and to share this and to help our climate tech companies grow, because the pathway to funding isn't always easy, and it doesn't need to be a straight line either. If everyone can put their cameras on, I'd love to get a little face shot. Okay. Just like, I mean, just to Lauren's point, we do have the company profile template, a Word doc. It's in your welcome pack. Please send your, send your photos through, send your news through. I love sharing it. And we have a great audience of those family offices, VCs, investors, angel syndicates in our network. Okay.
Yeah. I think, FinTech Australia launched in 2015, and there was 30 fintechs in Australia at the time when it launched. It's got hundreds and hundreds of members now, and it has genuinely put the spotlight on that particular ecosystem. I think we need to be able to point more to the incredible work going on in climate. So that's a great opportunity.
Wonderful. Thanks so much, Lauren. All right, smile. Smile, I have to go get the kids. Yay. Wonderful. Thank you so much, everyone, for your time. And